Okay, let's unpack this. Imagine you're running a small business. Could be, services, contracting, maybe seasonal retail.
Hmm.
You land a big client, great. Or a huge order. You do the work, send the invoice, and then, well, you wait. 30 days, 60 days.
Sometimes even 90,
Yeah,
easily.
90 days or more for that money to actually show up. But your bills, they need paying now.
Yeah. The rent's due, payroll's this week.
Exactly. You need inventory today for the next job. That gap between getting paid and needing cash, that's the classic small business cash crunch. It can feel, well, pretty suffocating.
It really is a paradox, isn't it?
Mm.
You're doing well, you've got the sales, but the normal process of business, waiting for payment,
Yeah.
creates this immediate need for funds you just don't have on hand.
And the usual routes like popping into the bank for a quick loan?
Often not really an option right then. Maybe the business is too new or you don't have much collateral they can look at.
Or the whole loan process just takes way too long.
Yeah, weeks sometimes.
So you've got this future income, it's locked up in those invoices, but you need the working capital like yesterday. And that's really where this deep dive comes in.
Mm-hmm.
We're looking at a specific financial tool for exactly this situation, accounts receivable factoring. We've been digging into an article that frames factoring specifically as bridge financing.
Right. And our mission here is to really pull out the key stuff from this source. We want to get our heads around what factoring actually is, how it gives you that cash fast.
Why it's seen as this kind of bridge financing.
Yeah, the pros, the cons, the things you really need to watch out for and, figure out when it might actually be the right move for your business to cross those cash flow gaps.
So let's start there. Why is this cash crunch so common? Before the invoices get paid, the source mentions the kinds of scenarios we were just talking about.
Like the construction company, right?
Yeah.
Paying for materials, labor every single week.
Yeah, but their client pays maybe on 60-day terms after a project milestone. Big gap.
Or think about that seasonal shop getting ready for the holidays. They're buying all that stock months ahead.
But the sales revenue doesn't hit until, what, December?
Exactly. Or maybe a tech startup, burning through cash for salaries, office space.
While they wait maybe 90 days for that first big corporate client to pay up.
These are all cases where the business is sound. They will get the money eventually, but the timing's just off.
And like you said, traditional debt isn't always the answer. A bank loan needs good credit, collateral, takes time.
Yeah, if you need 50 grand for payroll next Friday and the bank takes a month, that doesn't really help, does it?
Not at all. Okay, so if that's the problem, cash tied up, what's the solution mechanism? What exactly is accounts receivable factoring?
The article puts it pretty simply. You're basically selling your unpaid customer invoices, your accounts receivable,
Okay.
to a third-party company. They call them a factor, and you sell them at a discount.
Selling invoices. Okay.
And the real kicker here is the speed. Instead of waiting all that time for your customer,
30, 60, 90 days.
you sell the invoice to the factor, and bam, you get cash almost right away. The source says typically you get between, say, 70% and 90% of the invoice value up front.
Wow, okay. 70 to 90% fast. And then the factor, they collect from my customer.
That's right. They take on the job of getting the full payment from your customer when it's due.
Okay, let's walk through that step by step. The mechanics seem important here.
Definitely.
So, step one, I do my work, provide the service, whatever, send the invoice like normal. Standard payment terms.
Yep, business as usual so far.
But instead of just waiting, I decide I need that cash sooner. So, step two, I sell that specific invoice to a factoring company.
Correct. You approach a factor.
Step three, the factor, they check things out, right? Verify the invoice, maybe my customer's credit,
Absolutely. They need to know the invoice is legit and the customer is likely to pay.
and then they pay me part of it up front. That's the advance rate you mentioned.
Exactly. That's 70 to 90%. They advance you that portion pretty quickly.
Okay, then step four. The factor collects the full payment directly from my customer when the invoice is due.
That's usually how it works in standard factoring, yeah. They handle the collection.
And finally, step five. Once my customer pays the factor the full amount.
Then the factor sends the rest of the money to you, the remaining balance,
Okay.
minus their fee, the factoring fee. The article mentions it's typically, 1% to 5% of the invoice value?
1 to 5%.
And that fee, that's the main cost you're paying for the service,
Yeah.
for the speed. It often depends on the invoice size, your customer's reliability, and crucially, how long it actually takes them to collect that payment.
Right, longer wait means potentially a higher effective fee for them, I guess.
Makes sense.
Now, the article we looked at really frames this whole thing as bridge financing. We've used the term, but let's nail it down. What exactly is bridge financing?
Yeah, think of it literally like a bridge, or maybe scaffolding. It's short-term funding.
Specifically designed to cover immediate cash needs until something else happens. Until you get more permanent funding or that expected income finally arrives, it bridges the gap.
The gap, got it. That makes perfect sense. What kind of gaps are we talking about?
Well, the source gives good examples. Bridging the time while you wait for those invoices to get paid the exact thing we're discussing.
Okay.
Or maybe bridging the gap while you're waiting for a traditional bank loan to get approved.
Ah, okay. So you use this while waiting for that.
Yeah, or maybe you're a startup waiting for your next investment round to close. Or even waiting to sell off a big piece of equipment or property. It's for those moments where timing is critical.
And the article mentioned because it's short-term kind of emergency funding sometimes, bridge financing can be more expensive or have stricter terms than, say, a long-term bank loan.
That can be true, yeah. The lender, or in this case the factor, is taking on a more immediate short-term risk, so the cost might reflect that.
Which brings us right back to factoring.
Mhm.
Why is selling invoices such a good fit for being a bridge? Well, first off, the immediacy. It gives you liquidity, cash, based on money you know is coming in eventually.
Right, it's just locked up, so you're pulling that future cash forward.
Exactly. It accelerates your cash flow dramatically. Funds that were stuck in receivables for weeks or months, now they're working capital within days.
Available instantly, so you can pay those bills, maybe jump on a new opportunity.
Precisely. And it gives you that breathing room, that short-term relief, while maybe you are pursuing something longer term.
Like waiting for that bank loan approval we mentioned? Factoring keeps the lights on?
And here's a really key point the source makes. Unlike getting a bridge loan, factoring isn't adding new debt.
Oh, interesting. How so?
It's structured as a sale. You're selling an asset, that receivable, that invoice.
Mm.
It's not a loan you have to pay back.
Oh, okay. So it doesn't mess up your balance sheet with more debt.
Generally, no, which is a huge plus for businesses trying to keep their debt levels down. Or maybe they just can't qualify for more debt right now.
That's a really important distinction. It's leveraging an asset you already created.
You got it. Plus, it's flexible and it scales. The more sales you make to good customers, the more invoices you have.
The more potential cash you can unlock through factoring.
Yeah, it adapts with your growth. The source points out it's great for businesses that are growing fast, where their need for capital keeps going up as sales increase.
Okay, so let's list out these advantages of using factoring as a bridge. Number one is clearly the speed. Cash in days, not weeks or months.
Unmatched speed, really. Often 24 or 48 hours once you're set up.
And that speed means better cash flow management. You can plan, pay suppliers on time, maybe grab early payment discounts yourself.
Avoid those late fees, yeah. Smooths things out.
And this one seems huge for a lot of businesses. Qualification isn't really about your credit score, right?
Mostly no. It's primarily based on the creditworthiness of your customers.
Yeah.
The ones who owe the money on the invoices.
So a newer business, maybe a startup with not much credit history, they could still use factoring.
Absolutely, as long as they're selling to reliable, established companies.
Huh.
That makes it way more accessible.
And it helps you grab growth opportunities. That big order comes in, needs upfront cash you don't have.
Factoring can provide it. Factor that new invoice or even some older ones. Get the capital, fulfill the order. You don't have to say no to good business.
That's powerful. And you mentioned some factors also handle collections.
Yeah, in what they call full-service factoring, they often handle the credit checks on your customers and the process of collecting the payment on those factored invoices.
So that saves the business owner time and hassle.
Lets them focus on running the business, making sales, not chasing down payments.
Okay, this is sounding pretty good. Maybe too good. What are the catches, the downsides? There have to be some, right?
Oh, absolutely. Let's be real. The big one is cost.
That 1% to 5% fee per invoice.
Yeah. While it might not sound like a lot per invoice, if you start annualizing that cost, especially if your customers take the full 60 or 90 days to pay, it can end up being significantly more expensive than, say, a traditional bank loan's interest rate over the same period.
Yeah, I can see how that could add up. People might hear that percentage and think, whoa, that's steep. Is that fair?
It's fair to acknowledge it's a cost, definitely. But whether it's steep or fair, that really depends on your other options, doesn't it?
What do you mean?
Well, if the alternative is you can't make payroll, or you have to turn down a really profitable project, or maybe your business even fails because you can't get cash any other way,
Oh, okay.
then suddenly that factoring fee might look like a very reasonable price to pay for survival, or for capturing that crucial growth. It's the cost of the opportunity, or the cost of staying afloat.
That's a really good way to frame it. Context matters. What else?
Another potential issue is customer perception.
Ah, right, because the factor contacts my customer for payment.
In many standard arrangements, yes. Your customer gets notified that the invoice was sold, and they need to pay factor company X instead of you.
And businesses worry that looks bad, like they're in financial trouble.
Some do, yeah. Or they just feel it's awkward or disrupts the relationship they have with their customer. So how the factor actually communicates with your customers becomes really, really important. You want them to be professional.
Yeah, definitely a sensitive point. Okay, what about qualifying? You said it's about the customer's credit. Does that mean all invoices are okay?
Usually not all of them. Factors want to minimize their risk, right? So they focus on buying invoices from customers who have a strong payment history, who are very likely to pay.
So if I have some customers who are maybe a bit slow paying or have shaky credit,
Those invoices might not qualify for factoring, which could limit how much total cash you can actually raise this way.
got it. And that risk ties into something the source really emphasized: recourse versus non-recourse factoring. This sounds like a big deal for the business owner.
Oh, it's huge. Probably one of the critical things to understand when you're choosing a factoring arrangement.
Okay, break it down. What's recourse factoring?
With recourse, you sell the invoice, you get your advance money. But if your customer fails to pay the factor, maybe they go bankrupt, maybe they just disappear, then you, the business owner, are on the hook.
On the hook how?
You typically have to buy that unpaid invoice back from the factor
Right.
or replace it with another good invoice. Essentially, you bear the ultimate credit risk if your customer defaults.
Whoa. So I'm still liable if my customer doesn't pay. That sounds, well, risky.
It absolutely is. But because the factor isn't taking on that final credit risk, recourse factoring usually has lower fees.
Ah, cheaper but riskier for me.
Exactly. You save on fees, but you have to be prepared to cover a loss if a customer flakes.
Okay, so then non-recourse must be the opposite.
Mostly. With non-recourse, the factor assumes the risk of your customer not paying specifically due to declared insolvency or bankruptcy. If your factored customer goes bust, the factor takes the loss, not you.
That sounds much safer.
It is for that specific type of risk. But, and this is important, non-recourse usually doesn't cover situations like disputes over the goods or services or billing errors. If the customer refuses to pay because they claim you didn't deliver properly, you might still be liable even under a non-recourse agreement.
Okay, so it's not a total guarantee.
Not usually for disputes, no. And naturally, because the factor is taking on that core credit risk of insolvency, non-recourse factoring comes with higher fees than recourse.
Right. Makes sense. You pay more for them to take on more risk.
It's a direct trade-off, cost versus risk protection. You need to decide what your tolerance is and how creditworthy you believe your customers really are.
That recourse-non-recourse distinction feels absolutely key. Are there other main types of arrangements?
Yeah, the source briefly mentioned a couple of others. Beyond the risk part, there's spot factoring versus full-service factoring.
Spot versus full service.
Spot factoring is basically doing it as a one-off. You have one big invoice or maybe a few that you need cash for now, so you just factor those specific ones.
Like a temporary fix.
Right. Full service, sometimes called whole ledger factoring, is more like an ongoing relationship. You agree to factor, say, all your invoices from certain customers, or maybe even all your eligible invoices, on a continuous basis as you generate them.
Okay, so one-off versus ongoing. And what about disclosed versus undisclosed? That sounds intriguing.
Disclosed is the standard model we've mostly talked about. Your customer knows the invoice has been sold to a factor and pays the factor directly. It's transparent.
Got it. Undisclosed.
Undisclosed factoring, which is sometimes called invoice discounting, is different. Your customer isn't told that a factor is involved. They continue to pay you, the business, just like normal.
Oh, so my customer relationship isn't directly impacted.
Potentially less so, yes. But once you receive the payment from your customer, you then have to immediately forward that money to the factor to repay the advance and cover their fees.
I see. So it maintains the appearance of the normal payment flow.
Yes, but it usually comes with stricter requirements. It's often only available to larger, more established businesses with strong financials. And even then, there might still be clauses requiring notification if things go wrong. It's less common for smaller businesses.
Okay, that's helpful context. Bringing this back to the bridge idea, the article had some great real-world examples, like that seasonal retailer needing cash for holiday inventory.
Perfect example. It's maybe, say, September. They need cash now to buy all the gifts and decorations for Christmas?
But the big sales won't happen for months.
Right. So they factor invoices from their summer sales or maybe even spring sales to get the cash injection they need to stock up. It bridges that gap between buying inventory and making sales. Without it, they might totally miss their biggest season.
Makes total sense. Or the construction company example, they win a new contract.
Big project? Great. But they need cash up front for materials, maybe pay subcontractors right away.
But the payment terms on the new project might be months out.
Exactly. So what can they do? They can factor the receivables, the invoices, from a project they just finished, money they know is coming, but maybe it's on 60-day terms.
Use the money from the last job to fund the next job.
Precisely. It bridges the gap between projects and their payment cycles, keeps the workflow moving.
And the tech startup one really hit home for bridge financing between investment rounds.
Yeah, classic scenario. They might have big contracts, maybe with Fortune 500 companies, generating steady, recurring revenue.
Sounds good.
But those big companies often demand long payment terms, 60, 90 days sometimes. Meanwhile, the startup's burning cash on salaries, development, rent.
Waiting for that next VC check.
Right. So factoring those reliable but slow-paying corporate invoices gives them the cash lifeline to cover expenses for those critical few weeks or months. It bridges them until that next funding round closes, or until those big invoices finally pay.
These examples really crystallize when factoring makes sense as a bridge. It seems ideal for businesses that have, predictable income coming.
But it's tied up in receivables. And importantly, receivables from creditworthy customers. That's key.
Yeah, and businesses that need funds fast for operations or to jump on a growth opportunity.
Speed is often the driver.
And maybe they want to avoid traditional debt, or they just can't get a bank loan quickly enough or at all.
Right. Especially common in industries known for those long payment cycles, like construction or manufacturing, or industries with big seasonal swings.
So if you're listening and thinking, okay, this might actually fit my situation, what should you look for when choosing a factoring company? The article had some pointers.
Definitely crucial. First, check their reputation and experience. Have they worked with businesses like yours in your industry? Do they understand your specific challenges?
Makes sense. And fees.
Total transparency is vital. Understand the advance rate they're offering, exactly how the factoring fee is calculated. Is it tiered? Does it change based on payment speed? Are there any other hidden charges? Get it all in writing.
And be absolutely clear on those recourse terms we discussed.
Crystal clear. Are you taking the risk if the customer defaults, or are they? And under precisely what conditions does non-recourse protection actually apply? Don't make assumptions.
Good point. What about flexibility?
Yeah, ask about that. Can you pick and choose which invoices you want to factor? Spot factoring. Or do they require you to factor, say, all invoices from a certain customer or your whole sales ledger? Find out what level of commitment they expect.
And finally, something we touched on earlier, how they treat your customers.
They're the most important soft factor. Remember, if it's disclosed factoring, they will be interacting with your clients. How professional are they? How respectful? Their actions reflect directly back on your business reputation. Maybe ask for references you can talk to about their experience.
Excellent points. So wrapping this deep dive up, it feels pretty clear that, accounts receivable factoring can be a genuinely powerful, very flexible tool for small businesses. It acts as that essential bridge over those sometimes scary, temporary cash flow gaps.
It really can. It offers that incredibly fast access to capital by essentially unlocking the value in your future income.
Oh.
And importantly, it does it without piling on more debt.
Okay.
But, as we've stressed, it definitely comes at a cost. That fee structure needs careful consideration. And you absolutely have to get your head around the nuances, customer perception, yes, but especially that critical difference between recourse and non-recourse and what risk you ultimately hold.
In the current economic climate, where being agile and really managing cash flow is just so vital for survival, let alone growth, understanding these kinds of options like factoring, it doesn't just feel smart, it feels kind of essential for business owners.
Absolutely. Which leads to maybe a final thought for people listening. Given all these variations we discussed, recourse, non-recourse, spot, disclosed, undisclosed, and that fundamental trade-off between the cost of factoring versus the speed and the lack of debt benefit, how does a business owner actually quantify if it's worth it for them? In their specific situation, what are the concrete financial metrics? Maybe things like their cash conversion cycle or the profit margin on a new order they could only take. If they factored, what numbers should they really be crunching to make that strategic call on whether factoring is the right bridge for them, considering the costs and potential customer impact?